If you are raising funding, this is what you can learn from Y Combinator-backed African fintech Cleva, which was founded by Stripe and AWS alums after they raised a $1.5 million seed round. In this series, I'm going to be reacting to successful fundraising campaigns and startups to give us all a reality check on what it actually takes to raise funding. I want all founders, especially early stage founders, to see the reality of what it actually takes so that you open your eyes and have them wide open when you undertake what is typically an insufferable and thankless process. Fundraising is hard. I'm hoping I can make your life a little bit easier. As a startup advisor that has overseen over 1,000 startups over the past couple years in our accelerator program and watched companies raise over 9 figures of funding, I think I've got some perspective that may help you if you're going to start this journey. So let's take a look at what's going on here. This is Nigerian fintech Cleva, and they're focused on a banking platform for African individuals and businesses to receive international payments, opening U.S. account. And they raised $1.5 million in pre-seed funding. What's important to note here is that the number of VC firms that are participating, these are not just angel investors, although they had several angel investors, but you've got 1984 Ventures, which led the round. Often VCs will say, come back to us when you have someone who is going to be the lead investor. So these are real players. Now, what you've got is what the lead investor said, a partner, and they said this quote. This is very important because they're looking at the market opportunity. He says right here, the team is uniquely qualified to address this given their experience building banking products at Stripe and robust platforms at AWS, their impressive early growth as a testament to the team's unique capacity to execute across Africa and the US. So first of all, massive market opportunity because of the current situation with hyperinflation. So it says massive opportunity right here, and then navigate hyperinflation challenges. Great. Big market. That's what you need. That's what VCs are going to be looking for. Then you've got experience in terms of being at Stripe and AWS. That is domain expertise. Team expertise is a really big factor here. And you've got impressive early growth as a testament to team's unique capacity. So the team has expertise, but then they've shown they can grow really quickly. So velocity is important. These are the main factors you want to take away from this. And you have to read between the lines when it comes to articles like this to understand, because genius leaves clues. On top of which, Y Combinator participated as pre-seed, and they don't start until the winter 2024 batch, which I believe starts this month. They also went and got more investment before they joined Y Combinator. The batch started. So that means they probably used Y Combinator as a jumping pad and say, hey, we got into Y Combinator, and people started looking at them. And that's what you want to do, is you want to use lead investors and news such as we got into Y Combinator to create that FOMO, because once they get through Y Combinator, they're going to be a hot ticket. They'll probably be higher valuation, and investors aren't going to get the best deal. So you might as well get your money in. If they're good enough to get into Y Combinator, well, get your money in and get the valuation at the early stage round. Now, in the interview, most likely what happened is the lead investor, the venture capital firm, 1984 Ventures, said, all right, we need to get some press out for you because that's what's going to get other ventures on board. What this demonstrates right here is that the founders understand the market. So here's what the founder said. Persistent challenges Africans still face in receiving international payments for their skills and products. A pain point. So talking about the pain point in the market that the founders identified through secondhand experience and extensive research. That's another way you show traction, is you get experience with the problem and you do extensive research. And this is an $18 billion opportunity. So your TAM is in the billions, and that's what you're telling investors right there. Another crucial factor is founder market fit. I want to point this out. You have the domain expertise, but you also have the market fitting the founder, or the founder fitting the market. The two founders are African, both born and raised in Nigeria. That makes a lot of sense that they would understand the problems, but look at all their schooling. They went to MIT and then Stanford, and then you've got experience at Amazon, Stripe, AWS, and Twilio. That's going to say a lot that really contributes to the success, and your ability to raise pre-seed funding is how good your team is. And then they talk about the market opportunity, and they talk about their story. We started with Nigeria because we know the market, and it's a big market. We feel like because of our backgrounds, we're well positioned to solve the problem at the global scale. So it's a land and expand strategy. We're starting in Nigeria. We're going to dominate Nigeria, then move to the rest of Africa and the rest of the global market. You're starting there, which is really great. Go to market strategy. Cleva has initially launched a service in Nigeria, allowing users to open bank accounts. Now let's look at the traction here. They have shown traction. The Delaware and Lagos-based fintech has facilitated the opening of U.S. bank accounts for thousands of Nigerians, processing over 1 million in monthly payments, and then watch this, experiencing a monthly growth of 100%. Month over month, they're growing 100%. This is the traction that they had before they got the investment. And so obviously they bootstrapped or they raised a little bit of pre-seed funding to get to this point in time. You have traction numbers like this, of course you're going to get attention from VC. So you've got domain expertise, you've got a land and expand strategy, founder market fit, and you've got initial traction up front. Now let's look at how the differentiation works. They've got key customer experiences and they've got a business model. So they're differentiating because this is a really competitive space. So how are they going to set themselves apart from the competition? They're going to say, we've got customer experience. So they launched their MVP and they're getting tons of feedback from customers, which is absolutely fantastic. But then they've got a differentiated business model. So they got feedback, and check this out. Meanwhile, this is a very important paragraph. Meanwhile, the YC-backed startup, which generates revenue when users swap and exchange their funds for the local currency, also charges a 0.9% fee on customer deposits and U.S. accounts. Notably, Cleva caps fees at $20, and that is different from the competition charging a 1% uncapped fee. So not only are they charging 0.1% less than the competition, they cap at $20. That is enough to say our business model will be different. So I can imagine talking to investors and they say, well, what about all your competitors out there? These founders can say, yeah, we know we've got competitors out there, but here's how we're going to be different. We're going to charge 0.9%, which is going to get people in the door because everybody's going to look at 1% and can say 0.9% is what we're charging, and we're capping our fees at $20. But then what's going to happen is the competition might go in and say, all right, so then we'll lower our fees to 0.9%. But these competitors, there's no way on God's green earth that they're going to drop their fees down to a flat $20 cap and maximum. That messes up their business model. So now you've got Cleva flying in under the radar and they're saying, aha, we've got something different. But then the natural question is going to be, well, then how do you make money? If 1% is the standard, you're charging 0.9 and you're capping at $20. So maximum you're going to make on every transaction is $20. What are you going to do? Well, most likely they say we're going to scale. We're going to have less overhead because of our technology, what we did at Stripe and AWS and Twilio, etc. And we've got all these other plans. So they had to make an argument with the investors of how their business model is not going to rely on the standard 1% charge that other founders in other startups are going to be doing, or these other incumbents. And then you've got here, this is important here, long term, we are open to Cleva evolving from just being a product-only service to being a platform, issuing APIs to do a bunch of other things that help us distribute services across African countries or around the world. So you've got this balance between long-term vision and short-term execution. They're shining their light there and they're impressing investors and saying, we have a vision to dominate the world, but we're good enough to do short-term and get those thousands of accounts open and process $1 million of transactions. That's the secret. And so if you're learning from this, you want to be able to tell investors, we have this big, huge vision, but we're managed by short-term execution and we're focused 100% on getting those results and driving the traction. There you have it. That's my reaction to this. If this content goes really good and I get some good responses from it and some feedback, I'll continue doing these reactions to different fundraisers to let you know how to position yourself and what it realistically takes to do fundraise at the same time, especially if you're trying to raise $1.5 million in your pre-seed round. Thanks again. Do the social media thing, like, comment, subscribe. As I said, feedback is totally appreciated. I will see you in the next video.